Why do you think there is a case for European equities?
The first thing to recognize about European equities is that increasingly they are a poor proxy for the European economy. For the large cap and mid cap part of the European equity markets, now about 50% of the revenues are derived from outside of Europe, with particularly the influence from Asia ex-Japan and Latin America being more important. So really with European equities, what you're buying is much more of a global asset class than a local asset class. The second thing to think about with European equities is the valuations are very compelling versus both history and versus other asset classes. Following the market correction of 2008 and 2009, European equities have never really regained their former valuations. And versus US equities or versus equities in emerging markets or versus fixed income asset classes, the asset class is very cheap. The European equity market trades in about 9 times earnings, and many of the companies that we look at in the European market we think are very attractively valued. We think that European equities are also very underloved. Because of the crisis that has occurred in Southern Europe and peripheral Europe, there has been a reluctance amongst many investors globally and also within Europe itself to invest in European equities, as a consequence of which the asset class is very much underloved and underinvested. And because of that, we think the valuation has heavily discounted what we think are some quite positive fundamentals for many of these high-quality global businesses.
What is the outlook facing European equities in the light of the changing dynamics in the global economy?
I think the prospects remain as they have done for much of the last 18 months, which is quite good. The global economic growth rate is in line with long-term averages at about 3–3.5%. Now obviously what's interesting is that the level of divergence within the global economy is bigger than it has been historically, with much of the growth coming from emerging markets. But also within Europe, what is not commonly recognized is that many of the northern European economies are similarly very exposed to the faster growing parts of the world, and they too benefit from this. So we think the prospects for the global economy are pretty good, and also within Europe, for the northern economies, the outlook is quite good as well. So our kind of characterization of the global economy is that it's okay and quite supportive, and given the very cheap valuations of European equities, we think you're getting access to this growth at quite a reasonable price.
So how are you positioning your portfolios in the light of this outlook?
We have a reasonably significant growth bias in our holdings. We tend to like businesses that are exposed towards fast-growing parts of the world, or also those businesses that are exposed to dynamic change, innovation and technology. The areas we don't like are many of the financial services sectors, particularly banking, where we think the level of growth over the next few years is going to be very dimmed, and also where there is a risk of regulatory interference. We also don't like areas like telecommunications or utilities, where we see poor balance sheets, high levels of required investment and low returns on capital. So genuinely we favour high return businesses with good growth prospects and companies that are exposed to a changing world which can benefit from that.
What will be the impact of the QE3 in the US on European equities, if any?
I think the actions of the ECB are actually far more important than the actions of the Federal Reserve. Now that's not to say that the Federal Reserve actions aren't important, but I think for Europe the key actions were taken last week by the ECB board under Mario Draghi, when he announced that in return for some conditionality, the ECB will be prepared to buy in unlimited quantities the bonds of any country in Europe where the bond yields have diverged too much from the ECB's view of their fair value. So what this means is that countries like Spain or Italy, where the bond yields have been relatively high versus Germany, will benefit from significant ECB support if they are in turn prepared to engage in the required level of structural change. That to us is more important because it takes away the tail risk of a uncontrolled Eurozone contagion. And that really is the bigger issue for Europe as opposed to QE3 from the US.